We finance 7 different types of properties on a regular basis, and today I'm going to rank those properties from easiest to finance to the most difficult. Single family residences are the easiest property type to finance. There's no inherent unique challenges with single family homes. They're just standalone, stick built properties with no major overlays or difficulties. Townhouses are very, very similar to single family homes. I'm going to consider them to be only slightly more difficult to finance, but still extremely easy, only due to the fact that they're almost always going to be part of a homeowners association. A lot of times townhouses are attached to other units, and therefore there are master insurance policies attached to the building, and we need to make sure that the master insurance is in line with investor guidelines. The next property type I want to talk about is a duplex. This is where it gets a little bit more difficult to finance, but I still consider it a fairly easy property type to get a mortgage on. Duplexes are unique in the sense that you can live on one side as your primary residence, therefore you can get the benefits of getting a loan for a primary residence, but you also have the ability to use future rental income on the other half. So you're kind of getting the best of both worlds here, but if we do have to use rental income on the other half to qualify, we do need to validate what fair market rent is, and it's a little bit of extra paperwork. Also, it's important to know on a duplex that conventional financing requires a minimum 15% down versus the 3 or 5% that's typically required on like a single family residence. The next property type is 3 to 4 family homes, also known as triplexes and quadruplexes. These are similar to duplexes in the sense that we are able to use rental income on the other units to qualify you even if you're buying the house as a primary residence. But 3 to 4 family units require a 25% down payment on conventional, and if you go FHA, you can still only make a 3.5% down payment, but it is important to know that on 3 to 4 unit properties, FHA does require the property to pass what's called a self-sufficiency test. Basically, does the house pay for itself through rental income on the other units? And it does get a little bit more tricky in that sense. Manufactured double wides. In order to finance a manufactured home, it has to be permanently affixed to the foundation and it needs to sit on real property. In other words, we need to not only secure the house, but also the land that it sits on. So it's very common for manufactured homes to be located in parks where the land is leased, the house itself is owned. We cannot finance properties like that. That would be called a chattel loan because it's not real estate. It does not sit on land. Also, there's a couple of quirks with manufactured homes. Conventional financing requires a 5% down payment. You're not able to do the 3% down payment that's often available for first-time home buyers. Also, we need to make sure that the HUD tags are in place. We need to make sure that the performance certificate is up to code as to where the property is physically located, and we need to make sure that the foundation is solid for a lot of loan programs. So there are more inspections and more fees tied into manufactured housing than there would be for other property types, but overall it's not a super difficult thing to do. Sticking with manufactured homes, the second most difficult property type to finance is a manufactured single wide. All of the same parameters that we talked about for double wides also apply to single wides regarding HUD tags, performance certificate, foundation inspection, etc., etc. But there's additional caveats to where you cannot finance a single wide conventionally if it's older than 10 years old. Now at Atlantic Coast Financial Services, we do work with a lender who does have a special accommodation with Fannie Mae to finance single wides as old as 1976, but most lenders will not allow financing conventionally on single wides that are older than 10 years. It's also important to know that Fannie Mae and Freddie Mac will not back a loan on a single wide manufactured house if it's in an HOA community, unless that HOA has been specifically approved by Fannie Mae. Most HOAs that have single wides are not approved by Fannie Mae because it's a relatively expensive and drawn out process to get HOA approval. Why this is, I don't know. It's one of those guidelines that I've never been able to make sense of, but that could blow up a deal very, very quickly if you're not aware of that. FHA is a lot more forgiving on single wides. There's no age requirements other than the house has to be built after 1976, but FHA doesn't really care if it's in an HOA or if it's older than 10 years old. And finally, the most difficult property type to finance by far is a condo. When financing a condo, the underwriter is going to take a really hard look at the condo association, and it makes sense because if the condo association isn't pulling in enough revenue or they don't have enough reserves to maintain the buildings and the amenities, then the property values there are going to plummet. So the underwriter is going to send out what's called a condo questionnaire to the condo association, where they're going to have to answer 101 questions, things like how many people live here, of the owners, how many actually live here versus how many are renting units out. They take a look at the budget, they make sure that the financials are safe and sound, they underwrite the master insurance policies, not only for the buildings, but if it's in a flood zone, they have to look at that. And they also look at insurance policies against fidelity and dishonesty from people associated with the HOA. So there's a lot of extra paperwork when financing a condo. We need to make sure it's a warrantable condo. We need to make sure that the structural integrity of the building is intact, because after those condos in Florida collapsed, those rules changed a lot. It's a lot more strict. We need to make sure that one entity doesn't own more than 10% of the units in the project, because that becomes a risk. If that person stops paying their dues, that's going to have a significant impact on the budget and limit the ability to fix things and maintain the units. We need to make sure that not more than 25% of the project is used for commercial use. There's just a lot that goes into condos. Yes, we finance them. Yes, I'm happy to take the application, but just know it's going to be a lengthier process than any other property type. Those are the 7 most common types of properties that we finance. There are a whole bunch of other property types out there, things like earth homes, geodesic dome homes. Hell, people have financed igloos, but we don't do stuff like that. That's like a super specialty lender. If anybody has any questions about whether we can finance a specific property and what specifically is needed, give me a call. I would love to go over your options. Thank you so much.